Hello everyone, I'm Riddhi Joshi and I extend a warm welcome to all of you for today's 45 minutes webinar on how can you leverage quants to plan your dollar hedges and investment portfolios. Our host, Mr. Abhishek Goenka, founder and CEO of IFA Global, a well-known expert in foreign exchange and treasury market over the last 18 years, he will guide us through this insightful session. So let's get started.
Hi, everyone. Good afternoon. I hope everyone can hear me loud and clear. Just say why, so I know that you can hear us. Kushal, Mehak, nice to see you. Soham, thank you for being there. Okay. So let's make this extremely interactive. So let's make this webinar extremely interactive. So a lot of things are happening globally, a lot of things on the global front, a lot of things on the domestic fronts. And the asset classes are moving all the way, whether it be bonds, commodities, interest rates, or foreign exchange. And everybody wants to know what's going to happen and what's the outlook like. But before that, I would touch on a few basic themes. So the structure of the webinar, next, would be, we'll first of all touch upon some global themes, which is in terms of what's happening on the central bank's action, de-dollarization trend. A lot of rupee trades are happening. People want to know what's happening, how the payment in INR has been made, and what's happening with China now. That's a big driver. We are affected, the entire commodity markets are affected, etc. So then we'll touch upon what are the strategies companies are using for this entire low carry, low vol environment. Exporters are getting tensed. Importers are feeling the markets are not going anywhere, nothing to do. And also some of the latest strategies which have come from banks and institutions. People want to know whether they're really worth going for TARFs, barrier options, forward extras, etc. At IFA, I'll touch upon how we make a view and how the hedging model has been taken care. And interestingly, we at IFA believe that a multi-asset model, multi-geography, multi-asset model helps you to capture good investment returns in the long run. And I think all equities in one country is a huge country risk. So how can you design a portfolio? And then we'll touch upon one of the most important parts everybody's been waiting for is the market view, right? So we'll touch upon what we feel about all the major asset classes. So next. So we feel, there has been a whole journey after COVID, when COVID struck, central banks had cut interest rates majorly. Post that, there was a war, Russia-Ukraine war, inflation went up. There was huge inflation across the world. People started increasing interest rates. And now we have seen interest rates all the way from countries like Europe to all the way US, increasing rates from around 375 basis point all the way to 550 basis point. And the interest rates are going up as if there is no tomorrow. I mean, look at the mortgages. The mortgages are quoting at around 7% in the US. People are having a tough time paying those mortgages. But still, the equity markets have been going up. The NASDAQ has been almost hitting the previous levels. The S&P has been going up. So the question is, why are people still investing? And why is inflation still high and not coming down? Now, that's a question everybody is scratching their heads. But the point I want to mention here is that definitely there is inflation which is soothing. Expectations are that by next year, interest rates cuts should happen because there's a huge debt that US is sitting on, and after interest rates reaching 5.5, $1 trillion worth of debt, interest is what they have to pay, and that's huge. So, and that's not only for US, it's for every central bank in the world. So they're all sitting at huge debt piles, huge asset liability mismatches. And if they don't start cutting rates, I think nobody knows what's going to happen. So I think whether they're going to cut rates after inflation is going to get moderated to 2% in US, or they're going to cut rates if something breaks. Now that's $1 million question, but then sooner or later they have to cut rates. That's the feeling. Maybe not the same, maybe next year. Apart from that, we have to also look at what's happening in China. Now, China had a very funny environment in the last 2, 3 years. At one end, there was zero COVID policies, they closed everything. Then they clamped down on the edtech sector, property sector. There was a huge bubble. People got nervous, scared. Foreign investors started selling stocks, bonds, everything. People started shunning China. People lost money in China continuously year on year. And people, swear that they're not going to invest in China. There was a huge loss of confidence and there was huge unemployment. And now when the world was raising interest rates, China decided that they're going to cut interest rates. And they are moving divergent. And why are they doing it? Because growth has taken a big hit. And now they have realized that China is really lagging and they need the investors' confidence back. They're talking to investors, they're printing money, they're putting stimulus, and they want money now. And lately, we have also seen that Chinese stock markets have really fallen down and the valuations are really lucrative. I mean, if you ask anybody who's a fundamental analyst looking at the valuation, I think the Chinese market is the best market in the world. But nobody wants to touch it because of the previous experience that they had. Also, the yuan has been weakening. Now, we all know that China, they always wanted to be a reserve currency, right? Like the US, isn't it? Just say, yes, if you're getting this thing. So you feel China can become a reserve currency? What do you guys feel? Just say yes. On the chat. Okay, I hope everybody can listen to me. In case you have any questions, you can raise your hands also. So the point over here is that one has to look at three things. One is what's going to happen in Chinese yuan, because a lot of people who are sitting here are into export and import business. And we should know that our central bank, the Reserve Bank of India, tracks the Chinese yuan versus INR very, very closely. It tracks the levels of around 1125 against INR. And if rupee gets too strong, they intervene because the Atmanirbhar campaign is there, Made in India is there. They don't want the rupee to get stronger as compared to China because they suffer a lot of imports from China. At the same time, they want to promote exports from China, from India. And also, what's going to happen in Chinese stocks is also going to impact India, because if sooner or later people start seeing value. Now, if you ask me, I see a lot of value in China. And I've been tweeting and putting on my LinkedIn post that we are long China in our equity portfolio, personal one. And 10 to 15% of my portfolio is in China, because I feel that the valuations are so lucrative that sooner or later, when they do some stimulus, ultimately, Chinese equities will go up. We cannot forget that it's one of the largest economies in the world, highest in innovation, and they will correct, but they will again come back to the course. And also how the commodities are going to shape up is also depend on how China is likely to behave. Because if China starts moving up, commodities will start having a bull run. So I think it's very important to understand what China is doing. Next. Now, one of the other themes which are very relevant in today's market is de-dollarization. After the Russian-Ukrainian war, I think when the Russian assets got seized, like FX reserves, I think they had $600 billion worth. And the world became scared, because everybody doesn't have a great relation with the US. And I think the overall reserves that India was, the world was having was around 75%. You know how much the reserves are gone for the global central banks over today? Just guess, anybody on the chat? How much the reserves have been fallen for all the central banks from 75%? What's the current number? So the central bank reserves have actually come down from 75% to 58%. Now that's a huge number. That means the world is thinking of an alternate. And people are buying gold. So if you see the gold trend has been continuously going up. Okay. So one thing is for sure, there is a shift from the US dollar. People are holding some yuan. People are holding gold. And large investments are happening into other areas. So people are realizing that because of the huge debt in the US, because of its uh, autocratic moves, what they have done from Russia, countries like China, which has around $1 trillion in US, are getting scared. And now they are behaving in a very irresponsible manner in terms of the debt issues that they have. They have $32 trillion. I mean, their interest rate spending is more than the budget of the US. So I think people are understanding that this is going nowhere, and the de-dollarization theme is starting to happen. Unfortunately, the world doesn't have a parallel reserve currency, and that's the reason US dollar is still being used actively. But multi-trade agreements are being formed. People are doing business with each other, Russia, China, India, Russia, and various other small pockets. They're trying to do business together. So this is definitely a theme, and they have issues in terms of governance now and issues in terms of debt. Both are a big issue now. Other issue that has been commonly discussed now is that, BRICS along have been discussing that they will have their own common currency. Well, there are lots of ifs and buts, and I think we are way uh, ahead of this, because it's likely not going to happen now, because some countries may have a lot of gold backing. So a gold backed currency between these countries is only possible for those countries which have a strong gold backing. And when you have gold back, then no country can come and print currency the way they want. And there are also discussions that they will back it with some earth minerals, metals, etc. But I don't think it's for all the countries in the BRICS. So I think it's way this just in a discussion mode. I think they're going to have a meeting in August. But that's also one of the themes which is getting discussed because of the US dollar's funny behavior globally. So next is rupee internationalization. Now, all of you would have read that there are trades happening in INR. People were paying Russian crude in INR. Then there was a discussion that INR is a depreciating currency, isn't it? Why would you like to hold a depreciating currency? So earlier discussion was that if we are going to 20-25% cheap oil from Russia, ultimately we'll be able to save $20-25 billion of the overall hit on the current account deficit that we take. Now, when the oil prices start moving up, that gap has reduced to around $7-8. So with our maths, that number is coming to around $12-13 billion. And now there are discussions that $12-13 billion worth of money has been invested in G6. Well, RBI has not given a clear picture on that. But I think the Russians are more interested to do their payments in dirham. So Vostro accounts have been opened in India in INR. Say a Bank of Mashrak opens an account in India. Money gets transferred in INR in Indian bank for Mashrak's account here. And ultimately, Mashrak pays that money to Russia in dirham, and dirham and USD is pegged. So there is no currency risk. Because people don't want to hold on INR because INR is depreciating. And also they don't import a lot of stuff from India. So they don't want to hold INR. But the trades have started happening in dirham. That's what we know. So that trend is happening. Having said that, when people talk about internationalization, one thing that we have to take in care is that for any currency to become international, it's very important that the currency needs to be stable. That's number one. The size of the global trade. In India, the size of the global trade is not much. I mean, if you talk about export-import trade for India, for a $3 trillion economy, I think it's very small, the size of a global trade. So the size needs to increase, capital account convertibility needs to happen, the currency needs to get stronger, and we need to have reserves of at least $1 trillion. And then only people will start accepting INR as a currency and be comfortable with it. Till then, I think people will still be comfortable with currencies like Euro and pound sterling and euros, in US dollar. So I think it's way to go. But one thing is for sure, de-dollarization as a theme have started. And in the next 5, 10, 15 years, I don't know when it's going to happen, but then there could be a situation where They have to do something, otherwise this entire debt issue is just going to flare up for the US. Next. So let's concentrate on some of the domestic themes, which is actually impacting the dollar rupee. Are you guys able to comprehend? Just say why? Everybody can listen to me, hear me? Yes. Thanks, Parab. So if you actually see for India, what really matters is number one, current account, capital account, and the RBI function. Now let's take it step by step. And that's what we have also built in our models. We don't want to take a view just because there is a short-term news, because there is some information coming from RBI or there's some information coming from global markets. I think a stable approach of taking a view is more long-term and more sustainable. We are not trading here, we are hedging. So I think the way I'm going to explain you will be having a very clear view of why we are saying what we are saying. So first of all, it's current account. Have the current account improved from last year? What do you think? Ramakrishna, Abhishek, what do you think? Current account has improved or not? Just say yes or no. Yes. So it's improved. So it's one of the most important thing for our country is the current account. So we have seen export minus import reducing. Imports have reduced, exports have also reduced, but then broadly our trade deficit has come into control. Services, as you see over here in the chart, has been broadly flat. So we have not seen a much difference in terms of services, but what we have definitely seen is that overall the current account situation have improved. Now, so we were averaging around 27, 28 billion. Now I think we are doing around 2 billion. So 5, 6 billion at least per month, we are saving on that particular front. Now, one of the most important factor that one has to take into account while we are looking at this is that oil. We know that we get impacted by oil. And we were importing Russian oil. Just imagine 43%. This number used to be around 5-10% earlier, or even less maybe. This has increased to 43%. So we're buying Russian oil. But there's an oil cap of $60. So if oil keeps going up, then in that case, we may not be able to get that much benefit, what benefit can be got earlier. So for example, if oil goes to $90 or $95, then obviously we have to adhere to the $60 cap that has been imposed by the Western countries. And then our overall cost of import bill will start going up. But as of now, I think what they are doing is they're increasing the freight cost. So the freight cost has been doubled, and that's the way Russia has been earning. But obviously they cannot increase the freight cost $30, $40. So there will be a situation where if oil goes up a lot, then we have a problem. And India gets impacted by oil, it's anybody's guess. So, and also we have long-term contracts with these Middle Eastern countries. So we cannot increase this 43% to 55%, 60%. So I think one very close thing that we have also put in our models is what is the rate of oil? And if oil goes above $80 cost to India and sustains there, our model also starts flashing a red signal. And till now, we are close to that level. But if it goes to 85, 90, rupee has a problem. FII flows, I think all our happy faces here. Equity markets, mid and small caps have been zooming really up. And we have seen $5 billion worth of money coming in on an average last 3-4 months. So what money we lost, the funny thing is that when the international investors actually took out money, the equity markets went down by 10%. When they actually brought money, they had to actually buy at a much higher rate, because the same amount of money, around 220,000 crores, market went up by 25%. So one interesting phenomena is when the investors rush out, the SIP flows try and protect the market. But when these people want to come back, they get the market expensive because of domestic money, because of yours and our money, which is there, and markets has been pretty matured now. So I think that's a pretty good sign for Indian equity markets. One interesting point that we need to see is the balance of payment. Now, current account is one, capital account is another. So you have to look at the capital account also. So if we have seen that continuously we are seeing that money has been coming on the capital account front, Yes, interest rates in the US went up. So ECB flows have been around 10 odd billion. Banking capital changes has been around 10 odd billion. Over here, we can see $20 billion worth of money have already come in. So even though we don't receive any equity money going forward, then also, and there is no exit, then also we are going to have around 76 billion odd for FY24. That gives us a BOP plus. So our reserves get added, which is a very strong positive for rupee. I feel that this number could go above 10 billion also. And last year we had it obviously negative that we saw. Now, one question that everybody is having in terms of exports is that nobody wants to book forwards. Now, I have clients over here whom we debated multiple times, and they debated that why are we last year the market depreciated and forwards did not make much money. This year we would not cover. Now, if a question I want to ask is that if anybody would not have been covered this entire last 7-8 months, 8 months back, what was the rupee? Anybody's guess? 82.5, 83 levels. Premium was 2.5%. Today also the rate is a similar one. What did you lose? The premiums. So everybody tracks the spot. Nobody tracks the premium. For us, when we run a rolling strategy, it is very, very beneficial. And we don't like to keep changing our models very frequently unless something drastic is happening. But we like a consistent approach. And I think that is what paid us the last 18, 20 years of business. And we don't get concerned because the premium is 1.5%. We still don't change our strategy. But the premiums are low. One thing that we have to track very, very closely is that the interest rate differentials have reduced. If the interest rate differentials stay at 1.5%, the premiums are likely to be there at 1.5%. But that also means the probability of rupee depreciation also decreases. Okay. Now, a lot of people are also discussing that if exporters are not selling in the market, does it not rupee should depreciate? Well, exporters have not been selling actively in the last 6 months. But has the rupee depreciated? The answer is no. Why? Because you have RBI. So RBI is playing a very interesting game, and everybody should understand it. What game they have to play? They are playing is they are not letting the rupee get very strong when there is a lot of flows. So when we got $20 billion worth of flows in the last 3-4 months, they did not get that rupee go very strong. They were building reserves, right? And when the dollar gets strong internationally because of some mayhem or because of some crisis, there was SVB crisis, there was crisis in UK, American issues, etc. They are intervening at 83 levels close and supplying dollars. Why are they doing it? Number one, they want the walls to be low. They want the walls to be low because they want the world to know that they can rely on this currency. Number two, excess depreciation is not good for inflation, not good for the investors. Excess appreciation is not good for exporters. And also, they are managing it very well with the Chinese yuan. So you need to track Chinese yuan, oil, RBI buying and selling functions very closely. So they are buying low, selling high. And in the last 8-9 months, they have not let the rupee go anywhere. And I feel that if current account is being controlled, like I just showed you, and overall your balance of payment is okay, we should not see a rundown on the currency. If oil shoots up to $100, $110, we might see 1.5, 2 rupees depreciation. But the question is, as a country, we don't have a problem. Our fundamentals are pretty good. Next. So that's what I was saying, that there's an extreme low carry, low vols environment. I have not seen in the past. The vols have been below 4% and dollar rupee is not going anywhere. And the carry has been also low. Historically, when the forward premiums come down, rupee depreciates. But this time around, the forward premiums have come down. People are extremely comfortable, but still rupee is not depreciating because RBI is active. And that's what they have told in this particular policy also. Next. Now, this is what I was mentioning. We backtested it because we don't want to take any call based on what we just feel or just somebody feels. Everything is data backed. And we're very proud about this fact that at IFA, we are passionate about testing things out. We don't want to just do something because somebody says anything. So if you actually run a 3-month rolling forward for the last many, many years, and you take the forward premium versus depreciation, you make money by selling forwards. It's a no-brainer. Even in the last 8-9 months, as I just told you, it's a no-brainer. Selling forwards have been lucrative. People get scared. People change their strategy. I don't understand the reason. You can reduce your hedge, increase the hedge a little bit, but not covering anything and hoping against hope that rupee is going to depreciate substantially. We are going to go be in a mess. I don't think that's a great idea. So we don't do that. Now, just take one poll. Now, can everybody see the poll? Yeah. When GP was at 1.10 and Euro was at 0.98, where were the USD INR? This was like what, October 22. You can put the poll. I mean, everybody can see the poll. Excellent. We'll just wait for 10, 15 seconds more. So I'll end the poll. So it's a mixed bag. A lot of people have said 81, 82, and some people have said 83. Well, the answer is 83. So most of the people got it wrong, and the levels of dollar rupee was nothing but 83 because dollar became very strong because of crisis happening in the US that time. And everybody thought that the US dollar is going to get very strong. RBI intervened. And so the point I wanted to show here is that rupee was 83. Today also it's 82.70, 82.80. But look at where the euro and GBP has gone. It has gone up by almost 15% higher. I mean, euro is 1.10 and pound sterling has gone up so much. So the real risk right now is not in dollar rupee. The real risk is happening in the cross currencies right now. Okay. Next, look at the euro INR, how it's gone up. I remember when euro was crashing, I was discussing with one of the clients and I said, if you have long-term euro imports, don't be greedy. If any currency has fallen 15, 20% in a year or two, just take an options and cover long-term. I mean, I have spent 20 years watching Euro INR and I understand that whenever it comes down by 15, 20% in a year, it's a buying area. And same thing for British pound also. The British pound collapse came to 85. It's a no-brainer that you should have gone and taken a British pound hedges for imports in case you have British pound. Next. If you look at the Euro INR, if you look at the realized vol versus the actual vol, the realized vol was higher. In case of dollar rupee, it's opposite. The actual vols which is there in the market versus the vols which is getting realized, that means the volatility is less for dollar rupee. Whereas in cross currencies, the volatility is more. So do not ignore the risk that's coming from cross currencies, whether it be JPY INR, whether it be Euro INR, or whether it be GBP INR. Next, see over here also in GBP INR, the vols are much more higher. Next, so we'll take another poll that how do you actually navigate this entire environment of low vol and low carry? Now let's assume that you don't want to go and cover forwards. What is your second plan option? So before that, I'll take a poll again and everybody see the poll. Which instruments you guys like for export and import? I mean, forward options, exotic. So now 25% of people have said currently that people like exotics. So 64% people have said, forwards and options, and 35% people, 36% people have also told for exotics. So it simply means that the market is evolving. Now, in my experience of dealing with companies overall, I see there is a lot of distaste for options. I don't know why. I think it's a great product. One should look at all the options, then take a call. What are you putting on the table? What is your risk reward ratio? Whether the option is hedge compliant or not, whether it's a cash flow hedge or a balance sheet hedge, whether at this point of time option makes sense or forward makes sense. And for exotics also, it's very relevant in today's environment. I don't see why it's not relevant. There are certain structures like forward extra, where you are able to sell forwards with a European knock-in, where you are trying to protect it also at the same time getting some participation. And you are just sacrificing 15, 20 basis point less than the forward. I think it's a great product. Why you should not do at 83? I understand some products like TAR, etc., for importers, exporters may not be very suitable because it's not 100% hedge compliant. But not using options because you don't understand option, I think the treasury should spend a lot of time understanding options rather than saying, okay, forward se theek hai, forward chalta hai. I am saying forward is good 80% of the time. But sometimes in terms of crisis, sometimes in a situation where the premiums have collapsed, sometimes when you are at a higher level or extreme low level, I think options make real sense. So we at IFA have a very, very strong options desk, and we strongly advocate that one should do a combination of forwards and options in your hedge portfolio. Next. So see that these are some of the structures which are available in the market. Okay. Today, because of the paucity of time, I am not going to touch upon every structure. On our website, you can see the payoffs of various option structures. There's a YouTube video on IFA Global's channel. You can go there. There is an option video that we have shot. You can go through it. There are certain blogs on the website. Please feel free to go there. There are payoffs of knock-in, knockout, when to do, what to do has been given. You can discuss with our team also if you have any issues. If a banker is coming, giving an option, we can help you price that, tell you whether it's suitable in the current environment or not. So I'm just skipping these slides. Exporter TARF. I'm not a big fan of TARF because it's not a perfect hedge. Now, when it comes to taking a view on dollar rupee, at IFA, after advising companies, hundreds and hundreds of companies, we realized that there should be a science of making a view. We just cannot say that oil is going up, so rupee will depreciate, or RBI is buying and selling, that's the reason this is happening. I think a systematic view helps you to take a long-term call. The way we do at IFA is that we have a quant model, and we have spent a lot of time building that. In that quant model, what we have done is we have backtested 35 factors. We have seen that 30 factors are not relevant at various points of time. We have shortlisted few factors. Based on those few factors, we have calculated that Z-score. We have understood those factors are relevant. Those factors have been given weight, technical and fundamental factors both. And then based on how those factors are changing, we give a parameter score. And based on that score is linked to the client's hedge ratio. Now, how does it make life simpler? Client knows that he's following a procedure. Our people know that we are following a procedure. Now, some of the people want to punt on a daily basis. They want to keep everything open, everything closed. Well, they are not our clients. We don't want them as our clients, because at IFA, we follow a very systematic approach of doing things. Also, those factors like current account, capital account, and RBI function has been given a lot of weight with some technical factors. Next. And the mother of all the factors, and these are the mother of all the factors, and all the other factors are below that. So we have done our maths, we have done the calculation for you. You don't have to put brains, just follow the index. The index follows from 36 to 180, and the hedge ratios are calculated accordingly automatically. Next. I think there's a beautiful article in Economic Times that we had published explaining the logic of this. So you can feel free to go to Economic Times and go to my blog, and then you can see all these factors over there. Now, everybody is very much interested in investing, so I'm going to touch a little bit on the investing, and then I'll come with a view on what the markets are looking at, what we feel, how should we position in debt, equity, etc. Are you guys, can you hear loud and clear? Just say yes, yes, yes. Can you all see the poll? Which is the investment class you would like to invest? Nowadays, India has so much of options, right? Large, mid cap, small cap, PE, VC, US equities, China, Japan equities, bonds. So no one wants to take US equities, seems like. What I see is that most of the people want to invest in mid and small cap. Of course, I mean, mid and small cap has been in flavor. Some people are also saying about bonds, and people love China and Japanese equities. I don't know, people read my post on LinkedIn, maybe some of the people, but then, of course, I like all the three, but it doesn't matter what I like or what I don't like. What really matters is asset allocation. So I think at IFA, we strongly believe that, so as you can see, most of them have given mid and small caps and China and Japanese equities and rated bonds. So at IFA, we believe next that a good asset allocation is very relevant. So even for my personal portfolio, I feel a multi-country, multi-geography portfolio is very relevant. Putting all your money in India and thinking that you're going to compound at 12, 14%, looking at back history, makes sense. India growing at 6%, inflation 5%, mid cap, small cap, another 2, 3%. So you can compound at 12, 13%. Who knows? But same could have been told for China 4, 5 years back. So nobody knows what's going to happen in the future. Smart investors across the world don't put all their eggs in one basket. So we don't do. So what we have done internally, we have made a multi-asset allocation model on the same lines of all-weather portfolio of Mr. Ray Dalio. I think we have taken NASDAQ, we have taken S&P, we have taken Indian bonds, we have taken Indian equities, mid, large, small cap. When do we take mid, large, small cap has been clearly defined in the quant model based on valuation parameters, sentiment parameters, momentum parameters. Everything has been captured. So what we have taken is, we have taken cues from the Goldman Sachs Financial Index. And what we have taken, we have calculated VIX, emerging market FX pulse, 10-year spreads in US, PE valuations of Nifty and S&P, and then technical factors like RSIs. And we have given it weights. Again, you have used Z-score, we have calculated the relevance, and accordingly, we have given an asset allocation. And the asset allocation for equities moved from 40% to 90%. How do we do that? That's the model decides, we don't decide. And based on that, I'm very happy to say that our portfolio was actually able to reduce the risk by 45%. Now, 45% risk reduction is a huge number. That means in equity, for getting a 12% Nifty return, you take a risk of 50% drawdown every 10 years, right? Like 2008 or 2020, equities can crash by 50%. What can we do so that the maximum crash can happen is 25, 30%? Not much, but the return doesn't get reduced and you can generate some alpha. That is the objective. Reduce risk, maintain the similar return, make it multi-asset, multi-geography, so that you broadly hedge, so you have removed the country risk. So out of 16 years, only 3 years we underperformed by around 2-3%. Broadly 13 years, we had an outperformance of around 2.2%. So that's huge. So time and again, we tested, again and again tested this. Of course, future we can't predict. But this worked. So the way we maintain is, we maintain this model. Based on this model, we'll decide how much to allocate to US, India, how much to allocate to large, mid, and small cap. Right now, it's definitely expensive. So our allocation have changed. So that's the way we move forward in terms of our investment model. So it's a very scientific way. So we help a lot of companies, promoters, wealth with this particular model. Next. Now, next. We come to the important takeaways is that, of course, I saw a lot of people were not interested in putting money in US. Now, if some people have been following me on LinkedIn, last year when NASDAQ had crashed, we were the first people to talk about investing in NASDAQ. Well, only because of valuation parameters. Today, I think yesterday only we posted that we are out of our NASDAQ portfolio. We don't like US anymore because the earning yield of equity versus what you're getting in bonds is almost the same. So why should anybody take equity risk in America? So I think we don't like it now. So we reduced our equity allocation there back. The recession chances in the US has been increasing. Interest rates are high, mortgage rates are high, earnings are taking a toll because of higher interest rates. And the Fed gauge is at 40-year high, which is at 67 for recession. Now, Now that's a big concern. Now, if they start cutting rates because something gets broken in US, then obviously the markets are going to fall down. Markets valuations are high, risk return is not justified. So we don't like America anymore. India is still moderately good. I'll come to the valuation parameters in India also. Next. Another factor, next. Another factor is that what we have to see is, if you look at the corporate uh, bond spreads with the FUD funds rate, that spreads is coming down. What does it mean? That people are very comfortable giving loans to companies in US, small, big, medium companies. So when these corporate bond spreads go all-time low, like you can see over here in the red chart, whenever it hit these levels, equity markets have crashed. So I don't know when it's going to crash, but I don't like it. I don't like in terms of valuations. I don't like these parameters. I don't like the earnings going down. So I would not like to take the bet. So 40% money has been made. We want to reduce our exposure there. So what's the outlook on other Indian asset classes? Let's move forward. So if you look at equities as a whole, we could see global equities. When I'm saying global equities, especially I want to make US, because US is where it's easy to invest for Indians. I still like China. I still like Japan. China valuation, as I said, is very good. Profitability could come down. For the Nifty, 1 year forward, we're almost 5% above the historical valuation, 1 year forward earnings, if I have to take. In fact, mid cap and small caps have started becoming a little expensive. The small caps are almost quoting around 15% above the historical valuation. So I think, yes, it has been like a straight line, but one has to be careful, because when small caps fall, it falls crazy. So at the higher valuation, you should start moving to large caps again. So you might ride the wave for some more time, but I think one should be a little cautious right now. Market cap to GDP, which is historically around 80%, has moved to around 105%. Now, at 80% market cap to GDP is very good, but at 105, as per Warren Buffett indicator, anything above 100 is slightly expensive. So I think in a medium term, Indian equity markets still look good. Corrections could happen, but one needs to carefully look at the valuations and then take a call on the allocation. You cannot, if it goes to 110, 115% market cap to GDP and you put all in money, then 5 years you don't make money. Like for NASDAQ, 2000 to 2008 was a lost decade. Like people didn't make money. So if you look at the valuation parameters from these mid and large caps, is slightly a little higher. So we are focusing more on growth and defensive, and we are a little underweight in US and like China and Japan. In terms of bonds, of course, supply is significant in Indian markets right now. After indexation benefit, HNI's lost interest. There, the supply came it reduced a little bit. And demand from debt market, mutual funds, and insurance sectors have actually come down. We have seen some bear steepening. SDL and corporate bond spreads have been broadly the same, not much over there. But we like 5 to 7 years bracket duration. I don't know if you people are following our webinars. Last time, I think I said we have started taking duration. And now on those bonds, even that 7% we invested, today we are sitting at 8.5. So today also, if you take 5 years, 7 years duration, even 10 years for the matter, I don't see a problem. And it could give you equity type return without taking equity risk by taking some duration. So we have put everything to long-term constant maturity bonds, 5 to 7 year bonds. We like it. Next. In terms of FX, we have been feeling that the US dollar has been weak. That has been our broad view for the last 1 year. Even the dollar rupee has not been going anywhere. We have earned the premiums, and currencies, euro, GBP, everything had went up. I don't still feel that dollar should get very strong. In India, I think the loose end is only oil and Chinese yuan. And if we start losing a lot of money from equity markets, then it's a different story. But if we are averaging even $1-2 billion a month in equity markets on an average in the next few months, and we don't see oil hitting above $90, we are good in terms of dollar rupee. And in terms of cross currencies, we are buying euro and GBP or any dips We like to sell dollars and buy these currencies. Broad range we have mentioned, and RBI is going to closely watch its balance sheet, rear, and all these factors to make sure where they want to maintain the rupee. In terms of commodities, I think oil is going to get supported because the US has spent a lot of money, used a lot of its reserves. But what will depend for oil is what China. If China comes back with a bang, they start taking a lot of measures and the growth starts improving in China, then obviously commodity bull run is going to happen. And then it could be a mother of all commodity runs. So we are keeping a close watch on that. So if that goes up and oil also starts going up, then we will start having an impact over there. So we have to closely watch that. But as of now, I think things are broadly flat. And gold overall is not going anywhere because people are finding better assets. But sooner or later, because of the de-dollarization theme and because central banks have been buying gold, any gold buying at lower levels is not a bad idea. But I don't think you're going to get a supernormal return. Maybe 7-8% annual return with some SGBs, Government of India gives interest. You can look at that option. Next. So how can we add value? Of course, quickly, can you make it full screen? We look at overall FX, interest rates, anything with regards to that. Anything we are passionate about portfolio management, passionate about markets, and we take care in terms of SOP processes, how things are going to get managed. And we are very proud about our thought leadership, the kind of views that we give, why are we giving it, the quant approach. Profitability gets tracked year on year for clients. So people know what they're doing, why are they doing, how much have they made money. Some clients want to outsource their FX dealings, banking negotiation, they don't want to spend time on that. And for some of the clients, we run FX as a profit center. We exactly know how to use options and forwards and make money. So we cannot take short-term bets. For long-term, how to make money, you come to us and we tell you how to do it. But short-term, if you tell us tomorrow where the rupee is going, I'm sorry, we don't have a magic wand. I can't tell you that. But broadly on a long-term, how do we make money? We know the tricks of the game. So that's all. Stay tuned. Follow our YouTube channel if you want, our website and our post, and you can get some interesting. Thank you so much. You'll get a feedback form. Please fill to fit the feedback. And look forward to have you in the next webinars too. If you have any feedback, just mail to us. And thank you so much for giving your time on this Friday afternoon. Thank you so much once again. Bye.
That was a great session by Mr. Abhishek Goenka. Anybody with questions?
I don't see a lot of questions, so I think most of the things have been covered, I guess. So we'll call it off. Thank you, Riddhi. Thank you so much. Bye.
Thank you.